Somebody is getting paid. There is a death benefit on a pool of money, and if you need to draw on that for long-term care, you can. Next question on the Get Ready for the Future show today is from Andrew in Russellville. I'm 52 with about $600,000 in retirement savings. My wife and I are worried about potential health issues in retirement. Should I cut back on contributions to fund an LTC policy, that's long-term care? Should I contribute more and self-insure? Andrew, great question, and it is a question that everyone should come up with an answer for in their pre-retirement years. So you're thinking right along the lines that we do when we work with our clients. We know statistically that 70% of Americans will need some sort of long-term care in their lives, and they definitely need to have a strategy or a plan to figure out how they're going to pay for that. Medicare does not pay for long-term care. That's something that is a very big misconception out there that people think is once I get on Medicare, I'm going to be good. So the issue and the whole question Andrew's asking, John, is how do I address long-term care? And he comes at it from the standpoint of I'm looking at my contributions to my retirement accounts. I'm building retirement savings. Should I cut back there so that I can fund or pay the premiums for a long-term care insurance policy? Or should I contribute more to the retirement account so I can build my own pool of money, if you will, so that it's prepared to be there for me, designated for long-term care? And the answer is to plan, because that's the only way you can determine, first of all, where you are. And that's the thing we need to determine first, John, is we need to know what the current contributions he is making, what it will do for him in retirement.
Yeah, let's kind of think about this very logically. There's 50-60% chance that if you are 65 and healthy, you're going to need some type of long-term care. There's 100% chance that you're going to need to eat and pay the utility bill in retirement. So I think that you've got to prioritize what's going on as far as retirement and be sure that your income is locked down as far as retirement is concerned, that you've got a really good handle on how much living expenses that you're going to need on top of Social Security. And if you have a pension, then is there a gap there between the money that you will have coming in and the money that you need to have going out to basically pay for your living expenses? If there is a gap, then you've got to fill that gap. And that's got to be your first priority. Beyond long-term care or anything else, you've got to fill that gap. Once that gap is filled, then you're talking about discretionary money. And I would say that long-term care has a higher priority than going on a vacation or something of that nature. You need to be sure that you're well taken care of in retirement if you have a long-term care event.
Yeah, so we need to determine if your future asset level will provide enough income to pay expenses and buy the things you want. And if the answer is yes, which again can only be determined through the planning process, then you could contribute more into an investment account earmarked for long-term care potentially. If the answer is no, then you might actually need to increase your contributions for retirement income and find a way to pay for a long-term care insurance policy. And that's something that we help our clients with through that Gen Wealth Ready to Retire process. So let's talk about what your options are when it comes to a long-term care policy and how that might fit into Andrew's question, John, because again, he's trying to figure out where to allocate dollars. That's the bottom line. So let's talk about where long-term care policies are and maybe when people should be looking into that. Andrew is 52, and he's kind of on the verge of thinking about that, but there is kind of a sweet spot as far as an age goes to when you should look for long-term care insurance.
Yeah, there is traditional long-term care insurance, and I was reminded this week of the problem with traditional long-term care insurance. The premium goes up. There is one company that I was reading about that in 2025, they're going to impose a 100% rate increase on their traditional long-term care policy because of claims experience, meaning that they're paying out more than they're taking in, and so the insurance company's got to raise rates. That is the big problem with a traditional long-term care policy. Now, they're out there and they're more affordable than a hybrid policy is. We'll get to a hybrid policy in just a second, but the traditional long-term care policies are under great pressure to actually cover these rising expenses of healthcare in a long-term care situation. So that's very, very hard to budget for when you are on a fixed income in retirement. So Scott, that is why we lean toward a hybrid long-term care life insurance policy, because there is a lot of fixed assets or fixed attributions to that long-term care policy that doesn't come into play in a traditional long-term care policy.
Yeah, bottom line, when you're in retirement, you want predictability, right? You want to be able to count on your expenses not going up. So, to John's point, that hybrid policy is a level premium from day one. Generally, it is going to start out a little more expensive than a traditional long-term care policy. And there's a reason for that, right? Because you're buying a life insurance policy. Somebody is getting paid. There is a death benefit on a pool of money. And if you need to draw on that for long-term care, you can. If you die suddenly and you never need long-term care, the death benefit is passed on to your beneficiary. So since someone's getting paid, there is a tendency for that premium to be higher in the beginning when compared to a traditional policy. But that traditional long-term care policy, as John mentioned, has a tendency to go up. So over the long term, it might not be more expensive. What it also allows you to do, since you are designated the amount of money that you are going to purchase with this insurance, is you may not have to insure for the full cost of care. If you think about making a retirement income plan for a couple, and let's say they're going to live on $9,000 a month, well, if one of those members of the couple need care, it's going to put a strain because most of that money is going to go to the nursing home. So the other spouse who is left behind is still going to have to eat and have to pay the bills, but it may not need the full cost of care, $7,000 or $8,000 a month. They may only need to supplement what they're otherwise receiving on a monthly basis from their assets and their Social Security. So maybe a pool of money that provides $3,000 a month, $2,000 a month over the course of a 3-year period might be what they need. And that, John, helps a couple potentially lower the cost of that premium.
Absolutely. Now, let's talk about the self-insurance thing. This can be a struggle because you don't really know what you're shooting for. You have no idea what the long-term care costs are, and it's all on you if you try to do this. And here's the challenge with this. If you take a look at perception versus reality, the average American couple estimates the total cost of health care in retirement to be $41,000. However, in actuality, the average 65-year-old couple retiring this year can expect to spend an average of about $315,000 on healthcare expenses throughout retirement. So big difference there in expectation versus reality. And 55 to 60 is really kind of a sweet spot to begin to look at these things. Most people think, I'm not going to need that till I get old. Well, the older you get, the higher the premiums are in either life insurance or the traditional long-term care policy. And trying to match that accumulation for when you need it, if you're trying to self-insure, can be a real problem, because if that long-term care event happens before you're ready, then it's just going to be an inadequate amount of money there to address the need.